Good afternoon, class. Good afternoon. Good evening, class. You're welcome to another class, and hope you had a wonderful day. So today we are going to move on from where we stopped last week on financial instruments. So last week we introduced financial instruments to us, and in learning financial instruments, I told you we're going to use IAS 32 on financial instrument presentation. And we're also going to use IFRS 9 on financial instruments recognition and measurement. So basically, we learned some part of IAS 32 last week and also some part of IFRS 9. Tonight, I would conclude the IFRS 9 part and also move to some part of IAS 32. The major focus last week, or part of the focus, was that we learned about the classification of financial instruments between liabilities and equity. We really focused on this one. So today, I would get to this point, compound financial instrument. But before we do that, remember that we said financial instruments are just debt and equity instruments from what we want to look at. And in defining it, we said financial instrument is any contract that gives rise to financial assets of one entity and financial liability or equity instruments of another entity. So for us to have a financial instrument, this definition has captured everything that must be in existence: financial asset, financial liability, or equity instrument. So before the financial instrument can even exist, there has to be at least two parties. One party must have financial assets, while the other party would either have financial liability or equity, depending on what is issuing, depending on the instrument is issuing to raise money. If it's issuing a debt instrument, then you would have a financial liability. If it's issuing an equity instrument, you will have an equity instrument. Then we pick them one by one. We explain the financial asset. I told you that financial assets are three things. There are three. Number one, I said financial asset is cash. Cash. And what is cash? I told you cash is cash. It's nothing more than that. Whether your cash in hand, your cash in bank, or your highly short-term investments, those are cash. Financial asset can also be equity instrument of another entity, and it is also a contractual right to receive cash or another financial asset. At this point, I gave you several scenarios to explain this definition. And financial asset could also be a contractual right to exchange financial asset or liabilities with another under conditions that are potentially favorable to the entity. Then for liabilities, we said there are contractual obligation to deliver cash or another financial assets, or to exchange financial asset or financial liabilities with another entities under conditions that are potentially unfavorable to the entity. Then we give some examples as well. And I explained to you very carefully that when it comes to financial assets, you need to understand this contractual right to receive cash. That it has to be a right to receive. I mean, what you are expecting must be cash. And that is why physical assets like inventory, like PPE, like intangible assets, they will not be. So that is why items like PP, intangible assets, inventories will not be a financial asset because they don't give rise to contractual right to receive cash. They only generate opportunity. They give opportunity to generate cash. We explained all of those last week. So we spent a lot of our time trying to understand. We spent a lot of our time trying to understand these definitions. So we looked at several scenarios like credit sales, bank savings, loan transaction, lease contracts. All of these items gives rise to financial instrument transactions because you see that there is one party that has a financial asset and there is another party that has a financial liability or equity instrument. Then I remember giving you this scenario as assignments after explaining all those points. I told you that you should go and try this. And most of you did not try it. Most of you did not try it, which is very sad because that means you will have forgotten the core principle of what I mentioned last week. So I advise you to go and watch the video and try this. And there's one person that sent it to me. I was supposed to send out the solution. Solution is in this and out. So I'll probably forward the solution to her if she reminds me again. I've really forgotten. Then we moved on to, after that, after those definitions and understanding from several scenarios, how to know whether an issuer has a financial ability or equity. Then we moved on to recognition and derecognition of financial instruments. This was what we moved on to. Yeah, sorry, just give me a few seconds. So for recognition, we said that financial instruments can only be recognized in the financial statements when the company becomes a party to the contractual provision of the contract, or when an entity becomes a party to the contract. That is when you can recognize financial instruments in your books. And I told you that an entity becomes a party to a contract from the date of the agreement or the date of commitment. I mean, it's just like you want to buy shares in another company, you want to invest. So at what point can you recognize that in your books? It's when you have made commitment. It's when you have actually paid for the shares. So for financial instruments, you must have become a party to the transaction. So you can only become a party when there is a firm agreement or when you have committed, mostly when you have committed. Then we looked at the recognition of financial assets, which is removal of financial asset from your books. We said before you can remove a financial asset, said one, your contractual right to the cash flows from the financial assets must have expired. Remember that financial asset is a contractual right to receive cash. That's one of the definition of financial asset, contractual right to receive cash. So when that right to receive cash has expired, then you have to recognize that financial asset from your books. Not only that, the entity transfers substantially all risk and reward of ownership of the financial asset to another entity. So when you transfer risk and reward, then you have to recognize that financial asset. So we looked at some scenarios, like 2 scenarios last week. And from those scenarios, you learned that before you can recognize financial assets from your books, uh, these two must happen. It's like 2 steps. Your right to receive cash must have expired, and you must transfer substantial risk and reward. If it's just only one that exists, that means you cannot recognize the financial asset. So the two must occur. So we looked at this scenario about a trade receivables that he collected money, but he didn't transfer the risk fully. We looked at another one where also he did not transfer the risk fully as well. So those were the 2 scenarios we looked at in those last week. We didn't stop there. We also talked about the recognition of financial liabilities last week. And speaking about the recognition of liabilities, we said you can recognize financial liabilities when it is extinguished. And extinguished means that when the obligation is discharged, that's cancelled, or expires. That is when you can recognize when it is extinguished. And we looked at a scenario together also last week, which was an ICAN pass correction where a company borrowed money and they have set money aside after some years to settle that loan. So they went ahead to recognize that loan from their books. I mean, saying that since they have set money aside, so you can recognize it. So they asked you to advise. And we concluded that they cannot recognize such loan because it has not been extinguished. Setting money aside does not mean it has been extinguished. So they need to continue to recognize that loan in their books. Okay, so those were the issues we discussed last week. So please, you need to revise these things and do the needful. I was even hoping you'd be asking me for more transactions because this one of IS 32 that we looked at these scenarios, you will need more transactions so that when you see a transaction, you will be able to know whether the issuer has a financial ability or an equity instrument. So mostly I would send you other scenarios also to practice with so that you can get used to them. And maybe other questions on the recognition of financial assets and also the recognition of financial liabilities so that you can see more scenarios on them. So those were what we looked at last week. Now, today, we are moving forward and I will be starting with measurement of financial instruments. How to measure financial instruments. So I need you to pay maximum attention so that you understand this also once and for all. Now, from the learnings of last week, you should have seen that financial instruments contains or has 3 elements. It has financial assets, financial liabilities, or equity. So when we talk about, we want to measure a financial instrument, so it's either of these 3, because this is what they can have: financial assets, financial liabilities, and equity. So we're going to pick them one by each. Okay, let me start with this one. Equity is not even in these notes. Equity, because I'll just make mention of it So if I don't make mention of it now, I won't remember. So why am I making mention of equity first? So when we say equity instruments, it means that an entity issued shares. So when you issue shares or share capital, you have equity. So equity is synonymous to your share capital and your reserves, majorly. So when we talk about measurements, I mean, when you have equity, when you issue shares, at what amount do you recognize that share capital in your books? Okay. So IFRS 9 did not talk about that. And that's because it's country specific. So in Nigeria, when you issue share capital, you're supposed to measure that share capital at nominal value. Measure that share capital at nominal value, in the sense that any amount above that nominal value will be recognized into a share premium account. So when you issue shares, they are recognized or they are measured at nominal value. And in reality, when we say nominal value, it's usually that price that you find on your share on the document that you registered with CS, on the document that you registered with CSC, that is where you find nominal value in real life. So that is how you measure share capital. It's not more than that. So no difficulty there. Now, the major thing is financial assets and financial liabilities. Now, for how do you measure financial assets? And don't forget that financial assets, I told you, are three items. One is cash, and that one you'll find that in this note. Because how do you measure cash? I mean, your cash is your cash. So it's what you have. That's the amount you put down in your book. So no issue with that. Not only that, financial asset is also equity instrument of another entity. And I explained that to you last week. Mean as that equity instrument of another entity means that you are invested in buying shares. You bought shares in another company. I mean, recently banks were issuing out their shares. Some of you might have bought, some companies might have bought. So if you bought it or your company bought it, you have a financial asset. Whoever had invested in those shares has a financial asset. So not only that, financial asset can also be contractual right to receive cash. That's when you have invested in debt instruments. So, I mean, the focus quickly for today regarding financial asset measurement, I'll be looking at those two where an entity has invested either in the debt or equity instrument. So generally, to measure any category of financial assets, whether you bought shares, whether you invested in government debts, whatever you have invested in as much as it's either a debt instrument or an equity instrument, you measure it at transaction price. It is initially measured at transaction price, and it is logical. Transaction price here means the amount that you invested or the price that you paid for the instrument. The amount that was invested or the price that was paid for the instrument. That is the transaction price. And that is the amount at which you would put those investments in your books. Now, going deeper, Let me narrow down into when you invest in shares, when you invest in equity instrument, how do you measure that? Remember that the investment in equity instruments we are talking about here is different from what Mr. Abiodun is teaching you. Those ones are investments that has given rise to significant influence, control, joint control. When you have those type of investments, the way they are measured are different. The way they are measured are different from what we are talking about here. Here, talking about investment or holdings that does not give you any kind of influence or control or joint control. So if that's the case, you measure those ones at the amount you have invested, which we call transaction price, the amount you invested. So it's that simple. That means that if you bought shares and you spent 500,000, that means in your books, all you just need to do is to debit financial asset equity investment, financial asset at the amount you paid. Of course, you credit bank. That's what we're saying. However, there's something we call classification of financial assets. Now, the financial asset I'm talking about now is equity investment. So when you buy shares, there are different motives or intention for buying those shares. And buying shares is different from when you buy PP or machinery. When you buy a machinery, you don't need to start explaining to anybody why you have bought it. Everybody knows that you are buying it for production. Or when you buy air condition in an office, you don't need to start explaining. Everybody knows that you're buying it for administrative purposes. Or when you buy a landed property that you want to build on, I mean, these ones are clear, their intentions are clear. But when you buy shares, there are different motives behind it. And IFRS 9 believes that those motives can be two. Two. Believe that you might either be buying to hold those shares for the short term or for trading, or you want to hold it for the long term. So we really need to know because they have implications. In the sense that if you are buying it with the intention of holding it for the short term, IFRS 9 says that you have to classify that equity investment, that financial asset. You classify it at the date of acquisition at fair value through P&L. At what? Fair value through profit or loss. But if the intention of buying this for the long term, then you would have to classify it at fair value through other comprehensive income. So from the above now, you will see that investment in equity instruments can be classified into either fair value through profit or loss or fair value through OCI. I mean, you need to understand that the only reason why I'm talking about classification here is because this is you're buying shares. We won't be sure why you're buying it. People buy it for different motives. It's different from other type of assets where when you buy it, everybody knows that okay, this is what you have bought it for. This is your intention. This one we need to know. It's important so that when you're reporting it, people won't be asking questions for that. From how you have classified it, we will understand why you have bought it. That is why this classification is necessary. I can ask you, So you guys are professional. So you don't just record financial assets in your books and just say that you won't just record financial assets in your books and just say that you have a financial asset. You need to let us know. You need to let us know the classification of that financial asset. It's important that you will let us know. So from what I've mentioned now, you need to carefully remember that when we say a financial asset is classified at fair value through profit or loss, means that our intention is to hold it for trading. We are holding it for speculation. That very soon we are going to sell it. But I'm just waiting. I mean, just like when some people bought shares of banks, a lot of people sold in January because they needed to pay school fees. Those ones, they did not just buy because they want to invest for the long term. They had that intention right from the beginning that I'm going to sell this. I mean, there was a time I wanted to save to buy something. I said, okay, instead of keeping this money in the bank, that was the time when MTN came out, issued out some shares. I said, okay, this IPO, let's buy some number of shares there. So I bought it. My intention, I know that my intention is that I'm going to sell this thing as soon as I'm ready to buy what I want to buy. And after a few months, I sold it and I bought what I want to buy. So right from when I was investing, I already know. And that is how it is for shares. Everybody knows. So if it's for the long term, those that will just invest and forget about it, that okay, I have no intention to sell. I have no intention. I mean, he's not even crossing his mind that he wants to sell. That is holding for the long term. That will be classified as fair value through OCI. So that's the first technical thing you need to know tonight. Now, having understood that when you buy shares, they have to be properly classified at the date of acquisition. Then let's look at this question. So, Wasi PLC, I bought 5,000 shares of BPLC, bought it for 2 naira, bought it on 4th January 2024. So Wasi PLC intends to sell the shares, at the end of the year. How would this investment be initially measured and classified? Okay, so let me deal with initial measurement first. So it's going to be initially measured at the transaction price. And in this case, what is the transaction price? Is the amount he paid for those shares, which is 5,000 multiplied by 2 naira. And that's 10 naira. And that's 10,000 naira. Right? So how will it be classified? Now, since the intention of is to sell these shares at the end of the year, that means he's holding it for the short term. He's holding it for the short term. And if he's holding it for the short term, that means he will classify these shares at fair value to POL. He will classify it at fair value to POL. So it means that in your books, when you want to describe that account head, you won't just see financial assets. You need to describe it fully. Because since you already know the intention of holding, so you won't just say financial assets in your books. You say financial assets at fair value through POL. This is how it is described. So even when it gets your trial balance and you see the line items in the trial balance, you will see, even if they don't want to call it financial assets, you see it's called equity investment at fair value through POL. Okay, so when you see such, then you will know that, okay, this one is for the short term. We bought it to sell it almost immediately. Okay, do we have any questions to this point? Please, I need you to be asking questions because I'll be building up on knowledge gradually. So it's going to get a little more technical.
Okay, so Mr. Wasiu, so what will be the accounting entry if we are measuring for true P&L? Sorry, I have cold.
Hey, sorry. Yeah, so like we have here, you're going to debit. Abidemi, you said if you are measuring at fair value to P&L, no, you have to use the right word. If you are classifying at fair value to P&L for now, that's the right word. So you're going to debit financial asset at fair value to P&L and credit back. That's the double entry. Okay, that's double entry. But what I'm concerned about more is this classification thing. You need to understand it very well. That when you are buying these shares for the short term, so it's going to be classified as financial asset at fair value to P&L, or you can be more specific because when you just say financial asset, we don't know whether you're talking about equity investment or debt investment. So you can say equity investment at fair value through P&L, but you need to put this at fair value through P&L there. It's very, very important. Very, extremely, because it's with that we'll be able to know whether you are holding it for the short term or for the long term.
I have a question, please.
Okay, please ask me.
Please, what is classified as short term and long term?
The
Let's say
shares
for
that the shares you're buying, if you buy shares, your intention is either you want to sell it short, you want to hold it for trading, or you're not even thinking about selling it at all. It's not even crossing your mind. Okay, so it's either of those two. So it's important that users of financial statement know why you have bought these shares in your books. So when you have an equity investment, you need to properly classify it either at fair value to POL or at fair value to OCI. Okay, so when you classify it at fair value to POL, it means that you're holding it for the short term. That shares that you are buying or that you bought, it means that you have plans of selling it the short term, whether in the next 1 year, in the next 2 years, in the next 3 years, but you know you're going to sell it. That means you're holding it for trading. So you classify it at fair value to P&L. So even in the exam, even in real life, when your company buys shares, you need to properly present the account properly. Don't just write equity investment. Oh, you need to put it equity investment at fair value to P&L or at fair value to OCI. That's if they are holding it for the long term. You need to properly present it in that manner.
Thank you.
Yeah. So if I may ask you, so if let's say you worked with a company and your company bought some shares, let's say they bought some Dangote shares and you are the accountant, so they came to give you the share certificate. I don't know, whoever bought it came to give you that you should put it in the books. Maybe they spent 5 million naira buying these shares. So how will you classify it? Is it fair value through OCI or fair value through PRL? Based on what I've said so far.
Sorry,
Just
sorry, repeat your question.
Yeah, Pascal.
I said you should please repeat your question.
I said your company bought Dangote shares worth 5 million naira. So they came to give you the share certificate that you should record that to your books. Yeah. So I'm asking that, how would you classify that equity investment? Will it be at fair value through POL or at fair value through OCI?
It will depend on the intention for buying the shares. So if the shares will be bought to be sold in the short term, then it will be fair value to POL. But if the shares will be bought for long-term investments, then fair value to through OCI.
Okay, but now they didn't tell you. You were not told. So in the exam, that's the beauty of exam. They will tell exam would indicate. But in real life now, they didn't tell you. So what are you going to do? How would you
Um,
have classified?
Sir, if we're not given the option to ask the company if we should classify it as fair
Let's say
value
you
to,
are, let's say you ask the guy and the guy said, I don't know, just record this thing for us, please.
I would classify it through fair value through PLL.
Why?
Because most people that hold Dangote shares, they always trade it in short terms for money.
You're perfectly correct. You're correct. So your logic for Dangote shares, maybe if you're speaking of another shares now that you feel people don't trade, maybe you'll have gone to for OCI. But what the standard said, what I, for example, said is, if you are not sure whether you're holding it for the short term or for the long term, if you don't have that sufficient information, the standard said that you should assume it's for the short term or for trading, and you should classify it at fair value through POL. So note that, please. Okay, having clarified classification. Okay, and remember, all this is happening immediately you bought those shares at the date of acquisition. You need to, because if you don't know the classification, there's no way you can know or describe the account head fully. So it's important you identify the classification. Now, you see, there's no way you can buy shares that you will not incur transaction costs. You will incur because they will charge you. You pay broker's fee, you pay stamp duty, you pay all sorts. You will pay. So we call it transaction costs. So how do you treat this transaction cost? The standard says that, see, the treatment depends on the classification of that financial asset. It's just like you bought shares 5 million, then there were some fees on it of 50,000. On that 5 million, fees, 50,000. So you're now saying, okay, how do you treat the fees? Then fine, okay, 5 million should go to financial asset. So what about the 50,000 fees? Okay, so the standard says that if the financial asset is classified at fair value through profit or loss, says the transaction cost will be expensed. And I'm sure by now you should know what expense means. It means it will be transferred or treated in P&L. You will take it as an expense to P&L. While it will be capitalized or added to the initial cost or transaction price if it is classified at fair value through OCI. So if the financial asset is classified at fair value through OCI, you are going to capitalize that transaction cost. And capitalizing, when you say capitalizing it, it means add it to the cost of the asset. So that means that 50,000, the total financial asset will become 5,050,000 in your books. And that's how you treat transaction cost when you buy shares. It's either you expense it, if you are classifying it at fair value through POL, or you capitalize it if you are classifying that financial asset at fair value through OCI. Okay. Now, at the end of the year, please don't sleep, wake up. Well, we're moving on to another advanced part. Wake up. So at the end of the year, which is what we call subsequent measurements. Subsequent measurements is at the end of the year. You're going to measure these financial assets in line with how you have classified it. Hence, at the end of the year, you measure the financial assets at either fair value through POL or fair value through OCI, which means that a financial asset that you classify at fair value through POL, you measure it at fair value through POL at the end of the year. So also a financial asset that you classify at fair value through OCI, you have to measure it at fair value through OCI at the end of the year. So what's the difference between the two? So the big difference between this measurement basis is where you take the gain or loss. To. So for fair value through OCI, the gain or loss on fair value is recognized to OCI. So which means that eventually you transfer it, that gain will transfer it to equity. Okay. So that gain, you can call it an investment revaluation reserve. Okay. It's just the same way like you have revaluation surplus for PPE that you take to OCI. Okay. It's the same way for this too. So when you make a gain on your shares, that gain is an income that goes to OCI. But it could be a loss too. It goes to OCI. It all goes to OCI. So the big difference for this one, when you are measuring at fair value to OCI, you have a gain, goes to OCI. When you have a loss, it remains in OCI. So you can become negative in OCI. Unlike evaluation surplus, that when it becomes negative, it goes to POL. So it's different from that respect. But if it is fair value through POL, the gain is recognized within profit or loss. So you take the gain to profit or loss straight on. That's the big difference between the two. And I want to believe that you all understand that when you buy shares, you can obviously make a gain. I mean, when you at the end of the year, and gain or loss simply means changes in the share price. It fluctuates. It's just like you bought the shares when you bought it, it was 2 naira, and at the end of the year is now 4 naira. Okay, so that gain, if you are classifying that shares at fair value through POL, that gain goes to POL. But if it is classified at fair value through OCI, that gain goes to OCI. Okay, so we'll solve questions later, but that's the principle for investment in equity instruments. That is all. It is not more than this. Not more than this. Okay. So still on financial assets, moving to investment in debt. So if your investment is in a debt instrument, like maybe you bought federal government bonds, or you bought commercial paper in a company, or you bought loan notes, if you invest in debt generally, how do you deal with those? Invest in debt, how do you deal with those? Like I've mentioned earlier, it's still a financial asset, and initially you're going to measure it at the transaction price, meaning the amount you have invested. Okay. So the new thing here is this: you need to immediately classify these debt investments also, because when you're investing in debt, you need to know why you're investing in debt, because there are no singular reason for investing in debt. There are multiple reasons. There are multiple reasons. Some people will invest in debt simply because they want to collect just interest. And at maturity, they collect their money back. While some people invest in debt because they intend to sell it when the valuation goes up in a few years' time. So people invest in debt for varieties of reasons. You know that if you keep your money with all these insurance companies, probably you have some money, then I said, okay, keep it with us, we pay you interest. That's also investing in debt. Okay, I have a friend of mine, an elderly friend. So he retired in 2010 with some loads of money. So he kept it with one of these finance house. And those guys, they were giving him a lot of money every quarter, so much money. And he told me that that's his intention. His intention is to be collecting those interests. So while some people's intention is not really about that interest, it's much more about waiting to just, yeah, debt, you always collect interest. It's a constant factor, okay? It's a constant thing. But in some people also have the intention of probably, if they have opportunity to sell and liquidate those investments, they will do it and move into another one that gives an higher yield, or probably because they have liquidity in it at some point in time. So we need to be able to tell from looking at your books. So we come back to classification again. So for debt investment or investment in debt instruments, there are three possible classifications. We have amortized costs, we have fair value through OCI, we have fair value through POL. Okay, these are the three possible classifications. And how would you know how to classify, which classification you would put your debt investment? How would you know? The way you will know is for you to look at the business model. What's the entity for managing this financial? So when we look at their business model, we might be able to know. And we would also look at the contractual cash flow characteristics of the financial assets. So these two majorly determines how you eventually classify these investments in debt instruments. So when we say business model, we are talking about how the entity manages the financial assets in order to generate cash flows. Okay, how does it want to collect cash flows? Is it from collecting interest and principal, or is it from selling the financial assets? Okay, so business model, as far as debt investment is concerned, is either to collect interest and principal, or to collect interest and principal as well as sell. So you need to understand these things. That first, when we say business model, you're talking about how you want to make money. Every business has a model. Every investment you make, you must have a business model. You must have how you want to make money in mind, right? Like all these YouTubes, for example, their business model is give people free videos, then you would advertise to those same people. So they make you the product, right? So we are saying that in this case, if I invest in debt, let's say government debt, so my business model, I have it in mind. Okay. So it's either I just want to collect interests, then at maturity, they give me back my money, because debt, they always give you back your money. That's a business model. In another case, see, collecting interest and principal is like a constant thing for debts, because you always get interest. But if you also have the intention of also selling, okay, that's an addition to just collecting interest and principal. So for us here, those are the two possible business models you can have. Secondly, is the contractual cash flow characteristics. Okay, meaning that there will be a contract, or there has to be a contract that will specify that you would collect interest and principal. It's not just enough that you have a business model in mind. There must be a backing contract that will specify that, okay, you have invested so much and you collect this amount of principal at maturity, and you collect this percentage of interest every year. There has to be a contract that will specify that. Okay. So still talking about classification, right? For debt investments, if there are three classifications like I've mentioned earlier on: amortized cost, fair value through OCI, fair value through PRL. So how would you know how to classify? I said it depends on your business model and contractual cash flow characteristics. Those are what dictates classification: business model and contractual cash flow characteristics. And I said business model is either you want to collect interest and principal, or in addition to collecting interest and principal, you also want to sell. That can be your business model. And very importantly, there have to be a contract that will state that you collect interest and principal. Okay, now let's narrow down to each of those classifications. Let's narrow down to each of them. Let me start with, if you want to classify at amortized cost, okay, don't forget there are three classifications. There are three classifications: amortized cost, fair value through POL, fair value through OCI. Those are the classifications. Now, if you want to classify at amortized cost, again, the basis is these two tests that I mentioned earlier on: business model test and the contractual cash flow characteristics test. Okay. So if your business model, meaning that the way you want to make money from this investment, is specifically or solely collecting interest and principal, okay, collecting interest and also principal at maturity, if that's your business model. And of course, contractual cash flow is talking about that there has to be a contract that would specify that, okay, you collect interest and principal. So you can classify at amortized cost. So you find that most debt investments, when you invest in debt, as an accountant, you find yourself majorly classifying at amortized cost. This is the go-to classification. This is the default. I mean, for the most part of it, this is the ideal one. Because most debts, when you invest in debt, most people is to collect is that interest. You see them asking, what's the interest rate? What's the interest rate? Is because they want to collect interest. And of course, you get your maturity back, your principal back at maturity. This one is like, it's silent because it always exists. There's always a contract that will specify interest and principal. So in your exams will not really pronounce these contractual cash flow characteristics that much. It's really going to focus more on the business model test, making sure you understand that when you're holding the financial asset to collect interest and principal, then you can classify at amortized cost. Okay. So this question, I won't waste too much time on this. Very straightforward. So it's talking about a company that he loaned 9 million to a subsidiary, then he's not charging interest, but he can request for that money anytime. He's not asking that, does this meet the conditions for amortized costs? Okay. So in as much as this guy is not intending to sell the financial assets, he's not intending to liquidate it anytime soon. That is waiting to collect his money back at maturity. That's his intention. Then that's amortized cost. Whether he's collecting interest or not is not really the thing. The fact that also that he can collect it on demand, that he will get repaid on demand also, means that okay, it's fine. We can classify it as amortized cost. Okay.
Sir, sorry, I don't understand.
Which part?
Can you just go over the explanation of the amortized cost again in respect to this question that you just spoke about?
Okay. Okay, but you understand these other ones so far, Abi?
I understand the classification basis.
Okay, good. So it's just this question. Okay. So again, this question is just saying that, okay, I gave loan to a subsidiary and I can get my money whenever I need it. Okay. So it's saying he has told the subsidiary that I should not pay interest, but I can get my money whenever I need it. So then I said, can you classify or measure that loan notes? That loan you gave to that subsidiary at amortized cost? Yes, you can. And the major reason is because you are not selling. You don't intend to sell. You want to get repaid at whenever time you need it. So in this scenario now, he's not charging interest, fine, but he's going to get back his principal. So he meets this basis. He passed this business model test. Okay, it passed this test, which is the major one for us. That the intention is to collect interest and also receive principal at maturity. So, though the argument here is saying that, okay, he's not charging interest, but that will not negate the fact that he's holding it to maturity. So we can go ahead and classify it as amortized cost because it meets it. So what we're just learning from there is that for basically or fundamentally for amortized cost, yes, there's a basis that says business model test. The intention is to collect interest and principal because popularly, when you borrow people money, you collect interest and principal. But I mean, in some related party transactions, you will find that they will not charge interest. So, but you can still go ahead and classify it as amortized cost in as much as you know you're going to collect your money back at maturity. So that's what this question is saying. But we'll move to more clearer ones. Okay, before I go to, let me just quickly mention just similar to that equity investment. You remember that equity investment we said is classified into fair value through P&L, fair value through OCR. And the same way we classify it is the same way we measure it. Remember? Okay, so let me quickly tell you this one too in advance. For debt too, if you invest in debt, The same way you classify is the same way you're going to measure at the end of the year. So if you are classifying at amortized cost, you're going to measure at amortized cost at the end of the year. If you are classifying at fair value through OCI, you're going to measure at fair value through OCI. If you are classifying at fair value through PL, you're going to measure at. So note that. So I've only explained this one, amortized cost, that for you to classify at amortized cost, the business model is that you want to collect interest and you also want to collect principal. That's the most important thing. That's the most that you want to collect interest and you also want to collect principal. Then you can go ahead and classify at amortized cost. This other one is just saying, okay, there should be a contract. Most of the time, nobody would talk about this other one. Because for it to even be a financial instrument, there has to be a contract. So that one is by default, but we just have to mention it. Just have to mention it. Okay. So having mentioned that, I've been saying amortized cost, amortized cost. How do you determine amortized cost? How do you determine amortized cost? So I think we can look at three scenarios to explain that. So when we say amortized cost, the principle is just that we need to charge interest. We need to recognize interest on the amount on the amount that is outstanding. So anybody that is owing us money, we need to be charging that person interest on the amount outstanding. So the money the person is owing us will be increasing. That's amortized cost. So that increments, the new value is the amortized cost. And that's why bankers used to have this amortization schedule like that they do. So that's amortized cost. So if you have, let's say you'd invested in a debt, you lend somebody 10 million at 5% per annum. With the 10 million repayable at the end of the 3-year term. Okay, if this is an example, you give somebody 10 million, person says they will give you 5%, and after 3 years, they will pay back your 10 million. So this means that every year I will recognize 500,000 as interest. So from year 1 to 3, they will actually pay me interest. So I simply debit bank and I credit interests, which I call finance income here, to P&L with the annual finance income of 500,000. So you will see that this my investment in debt is profitable because over the 3 years I will have made 1.5 million. If I'm making 500,000 per annum, that means I will have made 1.5 million over the 3 years. So at the end of the 3rd year, they will pay me my money, my 10 million. So I will simply debit bank and credit loan receivable with the principal amount of 10 million. And the transaction ends there. Okay, so this is a simple one. However, so there are instances where the loan will be repaid at a premium. Okay, or where there are initial transaction costs. That's where there might be a little bit of deeper look. So for example, now, you gave somebody 10 million at the beginning of the year. So the guy said he will give you 5%. But then he's going to give you 11 million back at the end of the 3 years. That is on 31st December 2003. So in this case now, you're collecting much more than your initial 10 million. Now you're getting back 11 million. Okay, I believe you can see the difference between this first scenario that you invested 10, you are getting back 10 million at maturity. But here is investing 10 million, is getting 11 million back at maturity. So if I may ask now, this 10 million that this guy is investing, how much is he making on top? What's his profit over the 3 years? Anybody?
1.5.
Again, louder.
No, okay, this 10 million. He's going to get 2.5.
That's correct. Did you say 1.5 or 2.5?
No, 2.5. That's 5% and the addition of 1 million at the end of it.
Thank you very much. Thank you very much. So this guy in this case now is making 2.5 million because he's getting 5% every year over 3 years. That's 1.5 million. In addition to that, he's going to get 1 million. Okay, unlike here now, where he's just making 500,000 every year, so 1.5. So now the contention is this, is that the finance income now, like Senior has rightly said, is now two finance income is making, the 5% and also the 1 million. However, you see, this 1 million, there is no question about the 5% that we are going to recognize it every year, 500,000 as finance income every year. But this 1 million, okay, is an income to the investor, no doubt. But it would be wrong to record the amount when it is received at the end of the 3rd year. Because you might be tempted to think that this extra 1 million, Shebi is going to get it at maturity. So that income will be received at the end of the 3rd year. And you think that is when you are going to recognize it. That would be very wrong. Okay, that would be very wrong. So the right thing is that these amounts will be recorded over the 3 years to comply with accrual concept. So rather than recognizing only 5% in our books every year, so we are saying in addition to that 5% we are recognizing every year, this extra 1 million we are making also, we need to find a way to recognize it every year. Yes, the 1 million, we are going to collect it at the end of the 3rd year. But, I mean, it would be wrong to recognize it as income at the end of the 3rd year because it was earned over the 3 years. We worked for it. Our money was down over the 3 years. And that's because that's why they are giving us extra 1 million. So that extra 1 million needs to be spread. You need to spread it. So the major challenge is how do you spread it? That's the major challenge. How do you spread it over the 3 years? So IFRS 9 already figured it out for us. So IFRS 9 says that we need to get a constant rate of interest. We need to convert this 1 million also to interest. We need to convert it to rates, to a rate. So instead of using 5% only, that means we need to convert that extra 1 million into a rate so that we can be applying that also on the outstanding balance to get an amount that we'll call income. Okay. So this rate now yes, that 5% and also a portion of the premium every year. So these rates will be given to you in the exam. They will give it to you. And they call it effective interest rate. Okay, in some textbook, they will say the method of spreading it is called effective interest rate method. But I don't want to bore you with those. I want to break it down for you. So this rate, they call it effective interest rate. So in this example now that I gave you here, let's say this rate is 8.08% per annum. So I want to assume you understand that this 8.808% would comprise of the 5%, which is the interest every year, and also that 1 million, they have now converted it to rates. In this case now, we can assume that that would be 3.08%. I mean, for it to increase from 5% to 8.08%, that means is that extra 1 million that they want to spread over the 3 years that is making it up to 8.08%. So, I mean, the breakdown is not really necessary, rather than for us to be able to know that we will need an effective interest rate method, an effective interest rate. Okay, so you see, the key thing you're learning here is this. What you're learning here is this, that when an entity invests in a debt instrument, and you see that in addition to the fixed interest, there are some additional extra cash flows. There are additional extra income. Then you should expect an effective interest rate. You should expect an effect. So what the learning here is, when would you need an effective interest rate? When should you expect an effective interest rate? That's the learning here. And it's simple, is when the repayment is a premium. When the repayment is a premium, expect an effective interest rate. Because that means your income is not just 5% anymore. It's more than 5% every year. It's now 8.08%. And it is this 8.08% that we're now going to be recognizing to P&L. Unlike this one, when we were recognizing 500,000, 5% of 10 million to P&L every year. In this case now, it won't be 5% anymore. It will now be 8.08% that we're going to recognize to P&L every year. Every year. Okay. So using that question, it's easier to do it in a table. So in year one now, remember, we invested 10 million. We invested 10 million. So our effective interest rate now, our income now is now 8.08%. So 808. And it's 8.08% on the outstanding balance. It's always applied on the outstanding balance. So we have 808. However, at the end of the first year, these guys are actually going to pay us 5%. Don't forget that it's 5% they agree. This one is just for accounting purposes, accrual concept. That's the income you should put in your books is 808. But out of this 808 income, we are only going to receive 500. We are only going to receive 500. That means that the balance of our investment now is 10,308, which is this 10,000 plus the increments, the income, our expectation of income of 808, out of which we got 500. So the investment balance is now 10,308. This plus this minus this. 10,308. We carry that forward to the next year. You apply 8.08% again on it, on this outstanding balance. It gives you 833. Again, they give you 500. You know, this 5% is fixed on the principal. It's fixed on the principal amount. So they give you 500 again. So again, you add this plus 833 minus 500. It gives you 10,641. Again, you carry it forward to the next year. You apply that same 8.08% on this outstanding balance, gives you 859. Don't forget, you still collect 500. Still collect 500. By the time you add this plus this minus this, it gives you 11,000. So the first thing you have to have the capability to do is this table. You need to be able to do it conveniently and understand what it is speaking to. So with this table now, you see this 808 is our income that goes to P&L. It's the income that goes to P&L. You see this 10308 is the amortized cost. Is the financial asset, which we're going to put in our non-current asset. Is the financial asset at amortized cost? If I may ask you, this new transaction, this new income here, this income here is, can anybody try to tell me what the double entry would be? This 808. How do you think we'll have recorded it?
That's interest receivable.
Okay. Okay, yes, I agree with you. Are you debiting interest receivable and crediting what?
Yes, you debit interest receivable, you credit the sorry. This is an asset. Not sure.
I already told you that this 808 is an income. So you credit income, finance income, and you debit interest receivable. This is 808. How about this 500? This 500, you credit that interest receivable to reduce it,
Debit bank.
and you debit back. Yeah. So that interest receivable to remain 308, which you are going to bring back to your financial asset account. That is what is bringing it up to 10,308. Okay. I always like to mention debit and credit because this is corporate reporting class. I mean, there is no way you should not qualify and you don't know debit and credit. To be a shame on us. So even though your exam would not ask you, they don't ask you this. The examiner just wants you to do this table. Right? But I think you should be invested in knowing double and debit and credits. You want to work as an accountant or as an auditor, you need to know it very well. Okay. So thank you, Nioma. So this 808, debit interest receivable, credit P&L as finance income. This money you received, you use it to net off the interest receivable by crediting it and debiting back. Okay. But ultimately, what shows in our P&L is this. And in my statement of financial position is this. Okay. Then on and on. Now, can somebody help me add this 808 plus 833 plus 859? Can somebody help me add those three together? Anybody?
2,500.
Thank you very much. 2,500. Which is the same as what Husseini actually told us when we were starting. When I showed you this question, he said this guy is making 2,500, and that's what we have gotten. So you see that we have logically spread that 2,500 over 3 years, logically using this effective interest rate method. Okay, so because looking at it, is making 5% every year, 500,000, which is 1.5 million. Then 1 million at maturity, making 2.5 million. So, but this is how we account for it. So the examiner will give you this 8.08%. You need to use it right. You need to use it right. Okay. That is it for this one. Any questions? If there are no questions, because I believe you should ask me something. This 11,000 or 11 million, you see that is jiving with, is the same as what you get at maturity. Okay, so how do you net off this amount out of our accounts when you collect your money back? What will be the double entry? How do you cancel it out?
Sorry, come again. How do you cancel out what?
The 11 million, this 11 million at maturity. Because you get paid 11 million. I mean, it's exactly the same as this 11 million they told us in the question.
Mm.
You receive back, so which is what we got in our table as expected. So when you receive it, what will be the double entry to cancel it out?
Would you recognize it? That's crediting the assets and debiting bank.
Correct. Absolutely correct. Thank you. Yeah. You debit bank, you credit financial assets. Absolutely. Okay. So,
Sorry, I have a question. So
okay.
how about the other one? The money is 10 million, but at maturity is 11 million. So
Yes.
when you're canceling it out, the 1,000 naira it does not go anywhere. The 1
Oh, okay.
million, sorry.
We have already taken care of that 1 million with
Okay,
this table. This has already helped us to do that already.
okay,
Because you can see in our accounts now, we are already having 11 million. So the financial assets has built up gradually to 11 million.
okay,
And we started from 10 million by recognizing that 1 million extra in piecemeal every year, bit by bit, using this effective interest rate. So that means we don't have to bother about that 1 million at the end of the year. We have already spread it over the 3 years. And that's why I told you to add this 3 for me. This 808, 83385. Now it gave us 2.5 million, which shows that we have actually spread out 1 million over the 3 years.
okay, sir.
Yeah. Okay. So that is it for amortized cost. This is how you get amortized costs. That's what we call amortized cost. So still on debt investments, another classification is fair value through OCI. Okay. And for you to classify at fair value through OCI, again, we need to look at the business model tests. We need to also look at the contractual cash flow characteristics tests. Okay. So for the business model, your objective for holding these financial assets is that you want to collect contractual cash flows, that is interest and principal, and also to sell. It is where the difference lies. So in this case now, you also have the intention of selling. when you also have the intention of selling or liquidating before maturity, then you have to come and classify that debt investment at fair value through OCI when you have the intention of selling. So that's the major difference between these two. That's the major difference between these two. Between OCI, fair value through OCI, and amortized cost. So for amortized cost, you will see that the business model is just to collect interest and principal. But for fair value through OCI, the business model is, in addition to collecting interest and principal, it also has the intent of selling. So note that. I mean, I kind of asked you I think a 7 or 8 marks on this. I give you a scenario question. In between, they now go together. The guy has an history of selling. He now said, how do you classify this debt investment? As much as he has an history of selling, that means he can sell if he sees opportunity to. So you should classify and measure the debt investment at fair value through OCI because he also has the intention of selling. That's the major difference. So in terms of how you then calculate, you see, this table I've done for you is a constant thing when it comes to debt investments because you always get interest. If the interest includes premium, you have to do this. So when it comes to fair value, okay, it means that this amortized cost we will fair value it. You will get the market value at the end of each year. So instead of 10,308, the market value might become 10,500. And since it is fair value through OCI, that means we are making a gain that we are going to recognize in OCI. You fair value it. That's just the difference. You are still going to do this table. You are still going to get your interest. So this amortization schedule or table, or the amortization cost is to be derived. So what makes fair value is the fact that at the end of each year, you get the market value. You get the market value. But ultimately, what is important today is that you should be able to know when to classify as fair value through OCI. And in this case, it is when you also have the intention of selling that financial asset. But you see this third one, fair value through P&L. This one, there is no basis. It's just that if you cannot classify at fair value through OCI or at amortized cost, then you can classify and measure it at fair value through P&L. If you cannot classify at fair value through POS, sorry, fair value through OCI or amortized costs, so just put it at fair value through POS. Okay, so I'm done with explanation of the principles around financial assets. Okay, I've explained equity investments. Okay, I've explained equity. I started from here. I've explained equity investment. I've explained how they are classified, the basis. We are holding it for the short term, fair value through POL. If we are holding it for the long term, fair value through OCI. And the same way you measure is how you measure it. When you have transaction costs, if it is fair value through P&L, you expense that transaction cost. If it is fair value through OCI, you capitalize it. And we went to debts. We said that one you can either classify it as amortized cost, fair value through OCI, fair value through POL. And we said the basis is looking at the business model and the contractual cash flow. We said to classify amortized costs, the business model is solely to collect interest and principal. And also I showed you how to determine or derive amortized costs. We looked at the simple one where, okay, normal interest and principal, and you collect back your principal. I looked at a more robust one where invested money and they are paying you extra amount as premium. And we saw that that premium needs to be spread over the 3 years, over the period of the investment. And we use effective interest rates to do that, which are going to be given. And that gave birth to this table, which we discussed them in depthly. Then for fair value through POL, we said that one, if you cannot classify at fair value through OCI or amortized cost, then you classify at fair value through POL. And for fair value through OCI, classify and measure up using fair value through OCI. If your business model is to collect interest and principal and also to sell. That's all I've mentioned so far. Any questions? Okay. So do you have a question?
Yes, sir.
Okay, you're saying.
Yes, sir. Like this, in regard to this contractual terms, and based on more respect, like this example, you agree that 5% is going to pay every year annually on your capital, and you agree on the contractual term that this percentage or interest is going to be reinvested every year. Take for instance, like this example, 10 million, and at the end of the year, they pay you 500,000, and you add it onto that 10 million to be 10.5. And you again do another 5% at the end of the second year. You add it onto it. How can somebody give this interest at the end of the 3 years?
Okay, so the way it works is this. The way it works is this. There's always a contract, right? And the contract will say invest. And you invest for a certain number of years. So when you invest 10 million, that 10 million is a separate instrument for 3 years. For 3 years. Now, the interest of 500,000, if you wish to want to invest it, that is another thing entirely, is another instrument.
Okay.
You're not going to aggregate it with that other one. You treat
Okay.
it onto separately like that.
Okay.
Yes.
Okay. Thank you, sir.
Those complexity will not arise. We will simplify.
Okay. Okay.
Okay,
Thank you, sir.
so you're welcome. Now, for financial liabilities in the exam, is going to be classified and measured at amortized cost. So, and this is similar to the amortized cost you learned under financial assets that I've just finished teaching you. It's the same thing. So it's the same principle, everything. Now, the major difference is that for liabilities, they are initially recognized or measured as net proceeds, being the cash received less any issue costs. In the sense that if you borrow money, when you have liability, you are the one borrowing money. You borrow 10 million and you engage a broker to help you raise that money. You give him 200,000. So the amount you're going to recognize as financial liability in your books is 9.8 million, which is the net, which is this 10 million minus 200,000. Please, I need you to digest that. It's extremely important to digest that. Extremely. So when it comes to financial liabilities, they are initially measured as net proceeds. Net proceeds. So you borrow 10 million and you pay the broker 200,000 out of that 10 million. So that means your net proceeds is 9.8 million. Okay. So let me use this one to to show you the final part of amortized cost. So let's see what PLC issued. When you issued, it means you are the one borrowing money. You issued 10 million, 5% loan notes on 4th January 2001. He incurred 200,000 issue costs. So these loan notes are repayable at a premium of 1 million on 34th December 2003, giving them an effective interest rate of 8.85%. Okay, so this is the scenario similar to the one we did last. We invested 10 million. We are getting 5% per annum. Then 200,000 issue costs. So we are getting a premium of 1 million, which means that at maturity, we're going to get 11 million since we are getting extra 1 million. So, and like I've explained to you earlier, this 1 million needs to be recognized over the 3 years. Okay. Not only that, we are incurring an issue cost of 200,000. This one also needs to be recognized over the 3 years. And that's what is bringing our costs. Instead of 5% now, is now 8.85%. So the interest we are suffering or incurring is now beyond 5 million because we are going to pay back at a premium and we're going to incur issue cost. So our effective cost, our effective interest payable is 8.85%. So we'll use this table still, just like I've taught you before. But in this case now, we collected 10 million and we are incurring an issue cost of 200,000. Don't forget. So for financial liability, we initially measure it at net proceeds. So 9.8 million. So 8.85%, which is the effective interest, multiplied by 9.8 million, that gives us 867. Okay, that's how much we are going to recognize as our finance costs. And we are paying 5%. And this 5% is on the principal. It's on the principal, not on these 9/8. It's on principal. And don't forget, the principal is 10 million. That is how much we borrowed. So that gives us 500. So 9/8 plus 867 minus 500 gives this, which we are going to carry forward to next year. So we're going to apply this effective interest rate on the outstanding balance. Gives us 900. That's the effective interest payable. Then we paid 500 out of these 900. So brings our balance to 10,567. That is this plus 900 minus 500. So this, we carry it forward again. We apply this 8.85% on the outstanding balance, brings it to 933. We pay 5% of 10 million. Brings our balance to that 11 million. So similar to what we have explained earlier, this 867, we simply debit P&L and credit interest payable. Same thing for this, the same thing for this. This 500, we are debiting the interest payable and crediting back every year. And again, if you add this 867, 900 plus 2, 933, you get to 7. Because that is our costs. Our cost on this money we are borrowing is 5% per annum, which is 1.5 million for 3 years. Plus 1 million premium we are paying, making 2.5 million. plus 200,000 each costs, making 2.7 million, which is what we have spread over the 3 years. I'm going to leave you here for today. If you have time, you can practice this question. There are some questions here that you can practice. Solutions are in your handout. Solutions are in your handout. If you practice it, it makes our work easy. I thought I was going to be able to teach you convertible instruments. I can actually teach it if I want to, but I just feel that I should not. You can feel the tiredness in class. So most likely I'll teach you these convertible instruments next week, along with impairments, of financial assets. Then that will be the end of financial instruments. Then we'll then look at some past questions. So to end it, past questions here. Then we'll go to a new topic, fair value measurement. Okay. So do we have any questions for now? So if you need the hard copy of this material, I will still update it and include some other things there. All the standards that Mr. Abiodun is going to teach you, everything should come to like around maybe 500 and something pages or thereabout. So if somebody has reached out to me for the hard copy, but we have not finished collating, so I will be able to send it to the printer to print for us at a very cheap price. So, but now we can do that. So if you need the hard copy, just let me know so that see how you can get a physical copy, because it will do you a great good if this material we are teaching you with is the one you're reading. Not that we teach you with this material. After class, you're not going to pick another material entirely and start reading. That's not advisable. And you can also get the hard copy of the past question too. We have that at our center. Just let me know so I can collate those that need it. We can print it together and spread it wherever you are for you to have it and use it to study. So please, is this material I'm teaching you? I've given you the soft copy. Okay, if you can print it yourself, go ahead and print it. If we believe you print it in group, the cost will be cheaper because the pages will still become bigger very soon. I will still send you the updated one before the end of this week. And now we'll be going to like almost 600 pages. So it's better we print it for you so that this is what you are sitting down with. When it comes to Scorpio reporting, this is your go-to book. Just sit down, read it along with past questions. And the good thing is that in most of these my notes, I already put the past questions there. So in most of the topics that I have in this book, all the past questions that they have asked in recent times, I've already put everything together. But that does not still stop you from buying the collated past questions as well. Actually makes sense to do that. So let's reach out. So I think we had a wonderful class tonight. I will see you guys next week. Have a good one.
Thank you, sir.
All right.
Thank you,
Thank
sir.
you, sir.